Hello, I'm Kathleen Brooks, a business journalist and the research director at a foreign exchange trading company. I've worked as a research director for the last 4 years and I hold a master's degree from the Columbia Journalism School. For me, the most important thing a business journalist can do is to make complex financial concepts easy for an audience to understand and enjoyable. In this post-crisis financial environment, breaking news is also important as things continue to change. I hope you enjoy my showreel and I look forward to hearing from you. Hi everyone and welcome to my market update for this week. I'm Kathleen Brooks, Research Director here for Forex.com. Markets have been fairly quiet this week and trading conditions can be quiet the last week of the month as economic data tends to be fairly thin on the ground. Now what does that mean? That causes low volatility, which can then cause slow moving markets, which can be frustrating for traders, but not to worry because we are gearing up for some major fundamental event risks in the next few days, including US labour market data at the end of next week, a European Central Bank meeting, and also the Bank of England. They're also going to meet, so expect a lot more volatility in the coming days.
These indications from the data, particularly for Europe, are so important. It's like we're thirsty for any data, almost like we're hanging on to it for hope that something's improved.
Yeah, I think that's a really good point. The markets literally are. They are waiting for the economic data because that really determines the next steps by the ECB, for example, in Europe. So if Germany shows signs of slowing, that makes it more likely that the ECB may just loosen their monetary policy further. Remember, they haven't embarked on the same levels of QE that the US have, that Japan has. So there's still a lot of scope there for the ECB to do more, but it will depend on you know, how strong is the economic strongest link, which is Germany in the Eurozone.
Yeah, and as I said, you can always be better. You can always be better, and that's the message.
And that's the same with trading, so we're consistently trying to learn. So even if you did make a winning trade, could you have maybe kept that trade going longer, maybe moved up your stop loss to protect your profits? Say, for example, if the trend was going in your direction, should you have stayed in it a little bit longer? All of these things and learning from them will really mean that practice does, hopefully, make you better over the long term.
If we take a look at some of the concessions that have been made, all sorts of headlines seem to have been coming out over the last 2 days. Perhaps a mansion tax could be off the cards, but he could be raiding the pensions. Where would you be putting your money?
Well, I think it's going to be a fiscally neutral budget, and essentially that means that he doesn't have room to spend any money. So if he's going to kind of loosen the spigot somewhere, he's going to have to make up for that somewhere else. Now, the mansion tax would be a pretty political move because it could potentially placate the Liberal Democrats, but then some in the Conservatives would be very upset by that. Pensions have been raided before in 2010, but there certainly is room to go again because right now you can put a £50,000 tax-free sum in every year, and some people will say, well, you have to be fairly wealthy to be able to put that in anyway. So that could be a fairly populist move if he was to go down that route.
Great, so that means now you can rest easy this evening.
We've managed our risk.
We have managed our risk. So if the market goes against you, you don't need to worry that it's going to completely wipe out your account. Essentially, you've specified how much you're willing to risk, how much you're comfortable with. And if the market does go up there, then it will close that trade down and your losses will be crystallised. So you always know.
What would it mean if Britain were to lose its AAA coveted rating? That would be pretty important. And would it come sooner than 2 years?
It could certainly come sooner than 2 years, absolutely. What would it mean? From a market's perspective, we've seen France lose its AAA, we've seen the US lose its. It hasn't had a really huge impact. However, in the longer term, it could have an impact because obviously we're going to be borrowing for a very long time. If our credit rating is cut, it suggests that going forward, our borrowing costs will actually be higher than they are now. But at the moment, they're incredibly low. So we wouldn't expect that to change in the medium term if we are cut over the next 2 years.
Obviously, we had a weak start to the account. Rather than getting stressed trying to recoup losses, it's more sensible in our view to take a measured approach and try to maintain our risk management rules that we spoke about in our Learn to Trade videos with Vincent. We're being very conservative as this account is for charity after all, so we won't be making any rash decisions. Instead, we're trying to make steady progress as we move through the rest of the time that we have.